record. Okay, hi everybody, welcome to the week of Wyckoff. It's Friday and I'm delighted to welcome an excellent presenter, a Wyckoff expert in his own right, Gary Fullett, who's with us here today. We haven't had any seminars with Gary for some time, so this will be a first for many of you who are members of the VSA Club or tradingthemarkets.com. But I worked with Gary a few years ago in Florida. We did a presentation there called The Best of Wyckoff, and in fact that whole weekend was stunning. It was a great weekend. We had David Weiss, we had Rob Hoffman, we had Gary, we had a whole load of people there. So we are actually delighted now to welcome Gary back into the VSA Club and Trading the Markets room. What Gary's going to talk about today is very Wyckoffian. It's not going to be VSA with signals. It's going to be all about Wyckoff and some of the key principles of Wyckoff. Listen very, very carefully because Gary is an expert in his field and we're delighted to welcome him. So I'll sit back now with my headset on and we'll enjoy you, Gary. All the best and over to you.
Great. Thank you so much. Well, I want to welcome everybody here today. It's an honor and a pleasure to work with VSA and Gavin. We, as I said, mentioned a couple of years ago, we did a Best of Wyckoff in Florida, which was, as you said, was very well received, and we got a tremendous feedback. This was one of the first times that we did that. I didn't think I did a great job with it, but I think the whole weekend was unbelievably more so than what we expected. So that was wonderful. But it's a great honor. So before we begin, I'm a registered commodity broker. Okay, so I have to have a disclosure on all the things I do. So I always start out with a disclosure-wise. Okay, there is a substantial risk of loss in trading commodity futures and options. Past performance is not indicative of future results. The opinions expressed here are those of Gary Fullett and LTG LLC, which is my introducing broker company, and are not to be taken as a recommendation to buy or sell futures or commodities options. This is for educational purposes based upon the teaching of Richard D. Wyckoff. Okay, so many of you are familiar with Richard Wyckoff, and obviously you're all familiar with VSA. And Wyckoff differs a little bit with VSA in a sense of they're basically based the same. They talk price and volume, but I use terminology that more Wyckoff terminology is more so than VSA does, because it's a little bit, it's still volume and price, it's still understanding price and volume, but I'll use some terms that maybe you're not familiar with, or maybe different terms than Gavin and Trade Guy uses, but believe me, they're the same as far as market behavior and action. So if there's something that you don't understand, you could give to Gavin, and Gavin can give feedback on it, and we can go that way to make sure that you understand as far as that way, okay? So having said that, let us begin. Welcome everybody here, a very, very nice crowd. I see we have a lot of people from probably a lot of different places. So as many of you know, I like to talk about markets that are current. I don't cherry pick markets. I pick markets that are current because if you're trading or interested in trading, we have to know where the markets are going, not where they've been. If you do things in hindsight, then it's easy to make a winning trade, right? No one ever lost money in trading in hindsight. Okay, so it's true that over 90% of people lose money in trading. There are certain edges that you can get, and you can put the odds a little bit better in your favor. And I think most people don't understand the premise of trading, which I think really puts them even more so the 8-ball. But trading is a risk venture. It has its potential as well, but there's risks involved galore. Okay, especially in markets that are news driven. As I thought about Gavin in the section we did in Florida, which was, as I said, unbelievable. Gavin, I know, talks about market manipulation and things of that nature, which is true. Much of it legal, much of it not, some of it not legal, Bernie Madoff as example. And I thought about that, and I wanted to create a story for everybody. It's something that I work on with my one-on-one and my students in my chat room. And I wanted to do something special for the VSA Club because I know how interested in a great club it is. So I wanted to show a story of how you can actually tell, and I know Gavin does bar by bar, how you can tell the story before it actually happens. I think actually, Gavin, I didn't discuss with Gavin yet, but I will show you something that the FOMC meeting will show you how the story came and how the market broke in the euro currency. Since we have a lot of foreign people as far as outside the United States are concerned, I try to gear that towards, I took a little bit of each market. Soybeans, the euro currency, S&P, so I gave a British pound. So I gave a little bit of everything for you to see today, just a little sample size of everything. And, you know, get a hold of Gavin if you want any more information from me, or you can go to my website. It's not a big deal, but I want to make this a great presentation for you. And obviously, with the hour, around 15 minutes, would be difficult to do everything that I like to accomplish. But hopefully Gavin will have me back and we'll be able to do that as well, too. Okay, so let's begin our chat. I was a floor trader, which makes me a kind of a unique Wyckoff trader, because most have not. I traded in the 80s on the floor, which does not exist anymore, but it does give me a unique perspective. So for what it's worth, okay? So I will show you something extremely interesting today, and I hope you enjoy it. So let's start out with the S&P, okay? And one of the things that I like to talk about is effort versus result. And I've been working extremely careful with, extremely close with this Wyckoff principle, okay? So let me just backtrack a little bit. And there are three, everybody can see my screen? Hopefully, you can see my screen well? Okay, so there are three Wyckoff principles. I'm going to write them out so Gavin can have them for the tape and everything else. And you probably know these through VSA, okay? And I'll try to talk slowly. People think I'm from New York. I'm not. I tried to talk slowly. This is basic Wyckoff. Okay, so there are three Wyckoff principles: effort versus result, cause and effect, and demand and supply. And you obviously know about demand and supply bars through VSA and Trade Guider. You probably know the effort versus result of the bars, and the cause and effect, which is the sideways trading range that leads you to the longer market stays at trading range, the more the effect of the potential move can be. That's either up and down. Okay? So we're going to exclusively talk about the story today. We're going to talk about effort versus result. We're going to talk about if you master these three things, you have a better likelihood of having success. Okay? Now, what we have here is a market. What we have here is a market that essentially is a point to where what? To where we have, this is current. We'll talk about a little bit current-wise here. So if we go to this trade and we go into the S&P, there's two phenomena that I want you to look at. And it's effort versus result, meaning volume versus price, okay? And that's obviously what VSA is predicated on, volume and price. And I'm going to show you Wyckoff principles and the story of that particular movement and trade, okay? So that is something that is extremely, extremely important. And I know that Gavin bases his, VSA and Mr. Williams base their company on price and volume, as I do mine. So this is interesting. So what do you, this is interactive, what I have, so you can be more than welcome to chime in and question. I can see your questions. So you see a bar action here. Now volume and price is relative to the area that it trades in. So in other words, if grains are trading in the summertime, they will tend to have, in the United States, they will tend to have higher volumes because of weather than they will in the wintertime. Makes a lot of sense. So I can't compare the day session, the summer session in July in Chicago, and then I can compare the winter in December in Chicago. We don't grow corn in Chicago. They do draw it down south and down under, obviously in South America, but it's not U.S. product, okay? So we compare the volume within the area of the market. This volume is here. We can't compare this volume to this volume, okay? It's a different story of the market. There could be news. There could be a lot of different ways and functions of that market, okay? So that's why it is extremely, extremely important. Extremely, extremely important, Okay, so that is why it is something that is important to understand the area of the market. Okay, this is misspelled. It's S-U-P. Okay, it's S-U-P-P-Y. Okay, so we make a high, and the market has good volume and good breadth. Okay, of the market, and we see. I'll blow this up for you, and we see the volume is an up bar with good volume. This is nothing bearish about this bar. It is a bar that is in an uptrend, up moving market, and the trend tends to be up. So someone quickly tell me your favorite color. Anybody have a favorite color? Anybody have a favorite color? Anybody? I'll take the first color. I'll give you the list of colors here. Anybody have a favorite color? Purple is it is. Purple it is. Thank you. Okay. So we'll do green and red next time, okay? So we have a bar that is a constructive bar, and the market has good volume. This in the high-end close. Now, one thing that I point out to you, that I pointed out to my students of late, is when we do Wyckoff's work was essentially, real briefly, was essentially wave structure, okay? So David Weiss does a fantastic job, devoted his life to wave structure, and David is obviously part of VSA, so I highly, highly recommend David. He's one of the best in the world in his work, and he has a book and everything else, and I highly recommend if he's on with Gavin and works with him, please, 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 my highest recommendation. Dave and I have done webinars together. Anyway, in seminars. Anyway, the market has, well, you see this greater strength to the up than the down, then the market's in an uptrend. When the market does this, it's down. That's all Wyckoff did. That's all essentially that Wyckoff did. These up waves and these down waves. Elliott took these waves and made them 3 of 5, 5 of 6, whatever he did. Okay, and he made it these little zigzags, and he made it into an Elliott wave type of structure that came from Wyckoff. Wyckoff did not invent anything. All he did is watch the markets of the great people of his time, Keene, Rockefeller, J.P. Morgan, and those people that you read about, Jesse Livermore. Gann interviewed all of them. So all the while, and also the terms that I'm going to use are by Bob Evans, not the restaurant person, but Bob Evans, somebody who actually was a disciple of Wyckoff that brought the course into reality, into life. Okay? So this is a normal bar. The next bar here is a bar that is a shortening of the upward thrust. I'm not familiar, I don't know if you understand a lot of these terms, but I'll explain it. It's a small range bar, okay, that barely makes a new high. It's called an SOT. It's a shortening of the upward thrust. SOT, okay? Takes a lot of lectures to go through everything else, but just we're doing basics today. What do you notice about the volume relative to the price of the bar previously? Anybody? What do you recognize about this volume, to this volume, to this bar, to this bar? Anybody notice anything? Anything? It may be a little bit different. And so I'll wait a couple seconds for answers in case you want to look at it. Okay. Bar is narrow compared to volume. Very good. Volume and range are smaller. Good. Lower volume than previous. Narrow range, price range, decreasing volume. So what does this tell you? What does it tell you? It tells you that the effort of this bar was good volume, and we're comparing it, right? Effort versus result. Thomas, right. Effort versus result was decent. This next bar, the volume was maybe what? 1/4 the size of this bar? And look at the volume. It's more than half, isn't it? That is an effort versus demand, okay? That is a red flag in one of our Wyckoff principles. That tells you that it's taking. That's why it was taking. It took a lot of effort to move up very little, didn't it? Now, it was a mid-range close. So going back to Wyckoff's wave structure, when we see a market that does not have the ease of movement to the upside, it becomes a red flag. Remember, when we do Wyckoff's waves weren't time. They weren't time charts. What do I mean? This happens to be a daily chart. You can see it up in the left corner. It's a daily chart. The daily chart has a finite time. Every time the market closes, it makes a print of that bar, high, low, close. The notch on the right is the close, okay? This notch is the open, this notch is the range, and this notch is the close, okay? If this was a day-and-a-half chart, the close would be different. So sometimes the close on a time chart is irrelevant because if it was a different, who said that a day chart is important? Who said that a 60-minute chart is important? Who said that an hourly chart is important, a 30-minute chart, a 240-minute chart? We do time charts because that's what we do time charts. Somebody decide, hey, let's do it that particular chart, okay? So it doesn't, right? It's not a wave structure. It's time dependent. Well, not all time dependent is good, which is why when many times you see Wyckoff people like a David Weiss do things, we won't necessarily put the time on there. I point the figure is not a time mechanism because we're worried about the strength and weakness of the market, not necessarily the time of the market. I hope that makes sense to you, okay? So, having said that, we can look, since we're dealing with a time chart, then we deal with apples and apples, and we deal with the time chart as is, okay? So, we see a lot more effort to go up, and the range being smaller. That's a red flag. Make an asterisk, make whatever you want to do. It doesn't matter. You make a note of that. It means nothing if we don't have the follow through or we don't have anything else. But it does tell you that if you're long, you should tighten your stop. If you want to be an aggressive person, okay, then maybe you take a shot to the short side. But what if just one word, if you were from Mars, you came here and I asked you, and you asked me, what is the most important word about trading? What would you tell me? Anybody? What is the most important word about trading? Absolutely. Thomas, you are correct. Not losing money? Patience? Patience is good. Not losing money is more than one word. Volume? Good, but only one part of the story. Timing? Well, yeah, obviously timing too. But timing is the word is trend. It's the most important. You always hear about trend is your friend. Trend is your friend. You learn about it. You believe. You don't believe it. You do it. You go against trend all the time. I have a lecture that I do about people with trending and they miss the long and the first thing they do is want to short. Okay, not accurate. It's wrong. Okay, but outside the scope of what we're doing today. Hopefully, we do more lessons on it. So trend is the most important point. Why? Because if I'm buying a market in an uptrend, okay, and I buy every support, and my stop is underneath the next support, if it's an uptrend, we'll never get hit. Or if we do get hit, we can make the money back rebuying the market. So the market, so much uptrend is higher highs and higher lows, a series of higher high, higher lows, not just a spring of it, but a series of them. Well, if I'm buying support and I put my stop under there, you know, except for some news that shakes me out, it's important. So if you have 8, 10 winners in a row and then get wiped out, you do it all day long. Statistically, the most successful traders in the world are right between 25 and 40% of the time. No, about 30 to 40%, I would say, more accurate, okay? The greatest traders in the world are right between 30 and 40% of the time. So you say, well, that's not a lot. I mean, I'm accurate more than that. Well, if you're a baseball player and you're right between 30 and 40, you're hit between 300 and 400, you're obviously in the Hall of Fame. You're making about $25 million a year. Okay? So someone mentioned here about not losing money. I've been on the floor. I've seen people make millions, and I saw people lose millions in a day. The making of the millions doesn't impress me. The losing of the money makes you cry, okay? But it's easier to lose money in this business than to make money. Again, 90% of people lose money in trading, okay? So the thing is that you could be right 30% of the time, have good risk money management skills, and do very well, okay? The difference is that most people do not trade with trend. They miss something and they do the opposite. The trend is the most important aspect of trading. There are times which you can counter trend markets when you see things, but in an uptrend, most of your trade should be from the long side. It gives you the better odds, and that's what we're doing. These are odds. Okay? Very, very, very important. So we see this market, and then the next market, we see the market have a very smaller range bar, don't we? We see a smaller range bar. No? All well and good, but the volume is still relatively high. That's what I call, in my world, stuffing. Okay? And I'll write the word here. It's a term that I use, okay? And what I mean is, in the term I'll explain to you, is that the buying that's occurring, it's not marking up. Market's not going up. Someone's controlling the market. Gavin calls it smart money. In Wyckoff's world, they call it the composite operator, the composite man. Okay? And we know that funds and specs buy new highs because they're looking for trend. So they're buying highs to go higher. And we know that if the market's stopping there, we know that strong money is stopping that behavior. Gavin explains that very well. Tom Williams explains that very well. And it's a matter of their holding the market. Why? Because if they allow the market to go higher, like this, technically the funds and the specs will overwhelm the CM. He wants to control the range here, so the technical picture does not look good, so he can mark down the market. Where is it where you have excessive range in relative to volume? We'll go into all that stuff. Hopefully, Thomas will do that. Okay. The question was, what is it where you have excessive range in relative to volume? It depends upon trend. It depends upon where it happens in the Wyckoff sequence. It's a whole lecture on that. Okay. So we have a market that goes down, and we see the market. Now, what do you notice here about the volume? You see the market drying up, don't you? You see the volume drying up. Yeah, you do have your spikes and everything else, but you see the market volume up. So you do not, there's a difference between selling and supply. Okay? The difference in selling is your normal range bar like this. That's a selling bar. I mean, that's a selling bar. The market is lower for the day, more sellers than buyers, market is lower. You have something like this. This would be a supply bar. Wider range, wider volume. Okay? And then we have a sign of weakness bar, which is on the right-hand side of a trading range, which we'll get into a little bit today if we can. So we see the market breaking. We see the shortening of the upward thrust. We see the stopping action by the CM. And we know there's adverse red flag. That tells us a story. What story does it tell us? It tells us that the market is not getting demand at higher prices, and the market then breaks. Okay? So the story is weakness that is occurring, even though the market's closing at the highs. Then that's a little more difficult one. Then we get a market that has marked down here. Marked down meaning we take away opposite trading range, and we go lower. Okay? This is a normal range bar. The volume picks up, the range picks up. Now, everybody, here's where you're going to help me in work-wise. What do we see on the next bar? What do we see on the next bar? Anybody? I'm glad to see a lot of people today. It's good. I want to thank you for your time. I know your time is, I do this for a living, and I know your time is valuable to us. So it's a tribute to Gavin and to everybody that that you're taking your time to be here today. Thank you for your time. So we see, you're right, Thomas, you're right, it is. You see effort versus result, don't you? You see effort versus result, don't you? You see larger volume. Remember, it's relative to the area. You see a small range bar, half the size, and the volume is higher. This is what we call stopping action, and this is what I call bag holding. Okay? Again, effort versus result, bag holding. What's happening? As I told you, the funds and specs sell new lows. That's what they do. That's their function of what they do. Okay? and the market had a high volume close. If the close is on the lows, would it make a difference? If that, or the close on the high, would it make a difference if where the close was in that chart? The answer is probably not. If it closed higher, fine. If it closed lower, probably not, because it's the range of the bar. So I mentioned earlier about closes not necessarily being important. They're not, right? If this was a 2-day bar, the close would be up here, wouldn't it? So the close is not that important. I was taught that, it used to be when I was on the floor and we didn't have overnight markets, a strong close in the S&P, everybody would go home long and they'd get out. I knew traders, successful traders, they go in 5 or 10 S&Ps on a strong close. And on the opening, they'd get out of half of them and keep half. But that's when the S&Ps had 200-point ranges. There were $1,000 ranges. At that time, they were $500 a point, up a point, not $250 like they are now in the minis. So we had up. So the stopping action created what? The volume. Okay? I'm going to explain to something that maybe Gavin knows, maybe doesn't know. Okay? When you come from weakness in the market-wise, and he talks very well about the CM buying weakness to accumulate. Once you're coming from weakness, you have people that are short the market. They're selling new lows. Every time the market makes new lows, which is why the volume increases on the breaks. When you get, and this is not the purpose of our conversation, but I'll just throw that business here. When you get these high-end closes with no cause, okay, this is the short covering that's occurring in the market. It's all the shorts that got caught, all the longs that got wiped out, they're rebuying the market. And you're seeing the market open up here and closing on the high because the people are selling it in the market. At the end of the day, they get out. They're day traders, and they get out in the day. So when you see high-end closes after, weakness, that's a short covering, okay? And it's more detailed than that, but that's just kind of what you see. And then if the market holds in the retest, it accumulates, okay? But that's not our conversation. So there's 2 situations here in which that occurs, in which the market has effort versus result story, effort versus result story. This one's more obvious because the volume increased with the volume, but this is compared to each other, the same story. Okay? The difference of a market is strong when a market tries to go lower, an increasing volume, and then immediately goes higher. Okay? This is very bullish because there's the lack of follow-through that occurs in the market, and we know that the CM by the composite operator, smart money, whatever it is, we know that the market, this is the news that's bearish on that day. We know that they sold the close because that's what they do. They're trend-following people. The next day, we have a spring of this low. Okay, we're not going to have the springs today, but one day maybe we will. Springs, this is Wyckoff's favorite spring. A slight penetration of the low. Okay? These are setups. These are edges here. Okay, edges to buy. Okay? We're not going into trade setups today, but that's what it is. And the market is going here. So let's just briefly talk about the action today. Okay, oh, by the way, here. This action in here, again, effort versus result at the lows. Increasing volume, selling. The next day, look at the range. Maybe a third of the size of this range, and the volume was almost the same. Not almost the same. It was about, what, 3/4, maybe more than that. So 3/4 almost of this range, and the volume and the thing is about a third. Effort versus result. Ultimately, we need to see demand in the market, and you get it right here. Increasing volume, increasing bar length. This is bullish because it takes out a vertical supply bar or a selling bar. This is bullish because here demand overtook supply. In a Wyckoff's world, we do this very, very cleverly, right? We put D over S, demand overtakes supply. If the market was not bullish, this would not overtake the supply out. It would stop here. Pardon me. Okay? So, edge, edge, edge. We buy springs and uptrends. We're at right now, okay, market-wise, okay? Any questions on this chart? I told Gavin I would we'd go for about an hour and 15 minutes or so, hour and 15 minutes. I tend to talk fast. I apologize. Trying to slow down. Stop me if you don't. Okay. Good. Let's go to our next chart. That was the easiest chart. That was good. How long are your Sunday evening sessions? They start at 7 o'clock Chicago time. Right now it's 9:30 Chicago time for reference. They go to about 8:15 on Sunday evening Chicago time. Everything I do is recorded. Everything I do is on the website. Okay, so everything is recorded for compliance reasons. So everything I do is on the website. Okay, and we do YouTubes on there as well too. You're welcome. Sunday is everybody's free, and we do one-on-ones, we do lectures, we do all this stuff. Okay, but that's not the purpose of what we're doing. Okay, so current, don't slow down. It's good, and I promise to slow down today. Pre-medication, I promise to slow down. Okay, we do actually do a chat room during the day. As far as that goes, you're more than welcome. It's free. Okay, so I promise to slow down. I'm really concentrating on slowing down. Okay, I'll give you the email address in a second to the website. Okay, so these are soybeans. Well, should we do let's do soybeans. I don't want to lose people. Let's do currencies, okay? Because people don't be interested in grains. Because I picked out something for everybody today, okay? Because I don't know what your interest is, so I picked out something for everybody today, okay? So yeah, it's neat. So it's Tuesday night, and then we have everything almost every night. Let's do the euro currency, and this is for Gavin, basically. Well, not Gavin. This is to prove Gavin's right. This is to prove Gavin's right. Okay? You remember the FOMC meeting last week?
Yep.
I'm sorry. Remember, this is Gavin. I had you in mind, my friend, when I did this because
I'm listening,
of your excellent work. Okay? So I will tell you how the CM set that up for you. Okay? And I'll put the email for you as far as that goes. But go through Gavin, asking question-wise, because it's his site and everything else. As far as so that's my site, ltgtraining.com. You can look me up in basic NFA and stuff like that. Okay, so you're more than welcome. But go through Gavin because this thing. So you don't need to prove Gavin is right. His ego's large enough. Nah, Gavin, believe me, Gavin is good. Just to present this the way he does, and Mr. Williams to do this, it's a lot of effort. Believe me, and he does a fantastic job. So. Even though we're a little bit different on our Wyckoff, but they're price and volume. But you know what? If you learn, I don't care if you learn I don't care. Just learn price and volume, and you won't get a better place than here. Okay, so this is the FOMC meeting. Right. Okay, this is the FOMC meeting, and you can see strength in the background. We're not going to go through this area-wise too. Okay. So let me go through this. So it was on the 13th, correct? What was it? Was that right? Narco-wise? Where were we at? It's right here. It was the 19th, wasn't it? It was Wednesday. It was the FOMC meeting, right? Okay. So let's show you how the story happens to unfold here. Okay? Let's show you the folding. So we have a market that's essentially up move. Okay? The market is higher. So the first type of selling that we get in the market, we get right here. Now, if my pen doesn't work, let me know, because sometimes with GoToMeet it doesn't work on me, okay? So the market is kind of a shakeout to the upside, and the market ends in a spring. It's a perfect Wyckoff setup, okay? We call this the edge, and we call this the spring area, okay? And the reason why we call them edges, okay, is David Weiss, I'm hopefully explained to you, or maybe he did, I don't know how many are fishermen. My drawings stink. But if you're a fisherman here, this is you. It's the fish are at the corners of the edges, the big fish, okay? Those of you fishermen could probably prove that. You get very small, dumb fish that hang around the boat. They get hooked. But the edges are where you get your fish, okay? Got this from David Weiss. I give credit to everybody that does their thing, okay? So these are springs that are edges to buy, okay? We teach how to do this, but fine. So The market goes higher, and this is normal behavior, isn't it? Market goes higher. It's the middle of the night, right? We're sleeping. Well, it's 5 o'clock in the evening. We're not trading, okay? The market goes higher, and then the market does something like this. Well, it's kind of normal. But look what happens here. The volume here is a bullish bar. Market goes up. Let me back up here. The market goes up on good volume. We get a little bit increasing volume. Why? Because we see the market going above the high and the funds and specs getting a little bit. It's 1 o'clock in the morning. Gavin is up having tea. I'm not. I'm sleeping. Okay? But he's with the queen having his tea, doing his thing. The next bar is a increasing volume to the downside. Well, you would expect upside. So I would tell you as a trader, well, the first thing I learned from the floor, if something doesn't look right, it probably is correct, okay? Initially, when you're experienced, you have nothing to fall back on. But when something isn't right, if the experience, you're probably right. If I'm in a theater and I smell smoke, I don't need to see the fire, okay? I will walk out and maybe if I see a spark, maybe it catch my interest. If I see smoke after the fire, I'm doing a Jesse Owens and I'm leaving, okay? I don't need to see a fire at the end to leave the theater, okay? Well, if I see something that doesn't look right, I get volume increasing to the downside after an up bar, that tells me the market may not be ready. It doesn't mean that the trend is over. It just means that the short-term behavior. Now, I know Gavin does a lot of short-term trades, a lot of short time frames. Chart is a chart is a chart. This happens to be a 240-minute chart, which is used for currencies by professional traders. Okay? Every 4 hours, a different market opens up around the world. So it's standard for watching market. Now, for a lot of people, a 5 minutes is a long time. As long as you understand Wyckoff principles, it's fine. Okay? The longer the time frame, the less acute ACUTE news that gets there. Okay? So longer time frame. If you get a news report on a Friday, the 5-minute chart is very important. It probably does nothing to the monthly chart. Okay? Longer time frame, Wyckoff's a trend following system, the better off you are as far as to catch moves. Okay? Do I trade tick charts? On the floor, I did tick charts. I do not do tick charts. I do watch them, but I do not trade tick charts. I do not do tick charts. I do watch tick charts though for the floor. Okay, I watch tick charts all the time because I was a floor member. But yes, I do. I don't do it in my charts when I teach. Have you written anything or references on volume versus result? People have been asking me to write a book for a very, very, very long time. I kind of have like ADHD, to be honest with you. So when I read a book backwards, and I look at the result and I go find out why. So for me to sit down and actually write a book right now is because my time is impossible to write a book from teaching and running a brokerage firm. But one day I will. One day I will. Hopefully, maybe collaborate with Gavin or someone. But I will write. It took David Weiss, but I will probably write something on it because lately I have a very, very clear understanding of effort versus result, going back to roots wise. And actually, David Weiss made me think about going back to the root wise of Wyckoff's work, and I'm using effort result a lot in my work and finding success with it. Okay, so you should write the book backwards. I should. If I write the book in like Arabic or Hebrew, you can read the book backwards. You can read it from left to right. That's true. You have a lot to offer. You and a good trader. You should really write a book. I know. Gavin wrote one, and Gavin actually wrote two. I think 2 excellent books. So I know. I don't. I will one day. I don't. But I'd rather teach people individually that are interested rather than I don't know. I mean, we give money to charity when we do the one-on-ones and stuff like that to St. Jude's Hospital. So I try to contribute that way. I'll be your ghostwriter. If you can do it, you can work with it. I'll give you the information-wise. So we have a market that goes about here. Okay, what happens right here? So we have a warning sign here, and the market breaks. Increasing volume. Why is bar? Is that a buying bar or selling bar? Obviously, it's a selling bar. That was your first hint on the 13th, 1 week, 5 trading days before the FOMC. It's very benign at the time, but it's the largest down bar with the largest volume on that chart. Is that correct? And my 8-year-old can see the same thing. You can see the fact that it is the largest volume to the downside. As Gavin likes to go, it's like a Yao Ming type of behavior, right? It stands out like a sore thumb, okay? I'm in Chicago, so we may call it Joakim Noah, but that's okay. But it's a large volume. It's the largest volume relative to the action and to the behavior. So the fact that it's a high volume break is a clue, but we have to understand the retest of the particular market. Well, if we have one bar up, the reaction back higher is extremely important. If the market makes new highs, we call that a shakeout. And I know that if you're with VSA, you know what a shakeout is. If the price and the volume lag to the upside, we know that that is some type of weakness. Now, I know Gavin sometimes will call that a sign of weakness, okay? In Wyckoff's theoretical classic schematic, it's not a sign of weakness, but it represents the same red flag that you have to be aware of, because a sign of weakness to Wyckoff occurs on the right-hand side of a trading range, okay? So in this particular case, we have a markup. That weakness bar is the first break, that we get coming from strength, okay? And the reason why you can't have markdown from that phase, you can go lower, the reason why you don't have markdown from that phase is because of the Wyckoff principle of what? Cause and effect. There is no cause to facilitate a down move. We can't violate Wyckoff's principles. You cannot argue with a principle. So this is weakness, yes. This is selling, yes. Then we see how long the market takes to rally. Well, we mark this. We're not talking about trend lines and how to mark lines, but we mark this particular line as being important. And so it's this bar we mark. These bars we don't mark as resistance because this is where markdown occurred. It's a whole lesson on drawing trend lines. And we do this. And this, we mark this because this is where the buying came in, okay? The buying came in. So we mark this in our trading range to build cause. You could tell one bar down in about 20 bars here. Remember we talked about the fishing where you don't want to fish in the middle? This is fishing in the middle. Now, if you have a small range chart, you can springs and up thrust in here galore, okay? But they're only scalps, short term. And that's what Gavin does very well in his things because he takes the small little time frame, okay? This is a 240-minute chart. But what you get here is a situation where the market is, you eat sausage, but you don't know how, you don't want to know how it's made. You eat peanut butter, but you don't know how it's made. Well, this is the sausage making here. This is where the market is kind of churning up and down, and people bullish, bearish, bullish, bearish, bullish, and it's not what you want to get caught into, okay, unless you're on a smaller time frame. So what happens is that here, when the market's here, you expect the market to go up to the high. When the market's here, you expect to go to the low. You don't know that, so you stay out of it. You fish at the edges, okay? So this was the clue that happened. Well, lo and behold, the market is preparing. It's building cause and effect. Okay, and it's cause and effect. But we don't have, so this is the market hitting Markov phase. We consider when it flattens out the left-hand side, probably giving too much away. And this is the right-hand side of the market. Okay, and what? And this is the right-hand side where we get the sign of strength, sign of weakness. This is your sign of weakness. It's not a pig. Sign of weakness, SOW. The right-hand side, look at the volume. Larger range, larger volume. Boom. Okay? Then this. You compare it. Two significant down bars on the downside. A stopping action bar. The selling is more prevalent than the buying. The selling is more prevalent than the buying. Okay? Everybody see that? Any questions? Lawyer's question. Some wrote, I have Gavin's books and David Weiss' books and Tom Williams' books. All great. Waiting for you, Gary. Maybe Gavin, David, and Tom Mr. Williams could write a book on my behalf. I don't know. Yeah, they're great books. Good. I'm glad you read them. Excellent. So we're concerned about, it's a spring of action, but it doesn't look like a spring because it's a sign of weakness. And the subsequent rally is important. What can you say about the quality of rally here? There's no demand. It's a lack of demand. How does this end? Usually very badly, but how does it end? It ends via an upthrust or a shorting of the thrust. In this case, the ideal sell is a retest back to the ice. We call this ice area in Wyckoff terms, Bob Evans' term, not Wyckoff's term. We call this ice support. I'm not sure VSA uses this in Creek, but it's the same premise. It's a breaking of the ice. I only do Wyckoff wise, okay? So terminology, I don't do anything else, okay? Weak rally and everything else, okay? You do not buy the first rally in weakness. You don't sell the first break in strength because you have no cause. Wyckoff principles, we don't violate them, okay? Market does this. So this was the FOMC meeting that was bearish, wasn't it? But look at the story right here. They showed you that one bar that instead of being markup, instead of making continue markup phase here, instead of doing this and going with the trend, what did the market do? It gave you the story right here. They gave you the hint right there of the story. That story became bearish. Then we see the subsequent behavior, which was a lack of demand, took 20 bars to go up, 1 bar to go down. So we get that wave structure that we talked about earlier about Wyckoff's work. Okay? And we get the sign of weakness. Classical Wyckoff behavior. So, Gary, where's the edges? Where can I get short? Good question. There's 3 ways to get short after you see this. 1, an up thrust. 2, a retest. Okay? And 3, if the market's weak, about halfway back of a range. Okay? But having said that, we didn't have that behavior. We didn't have perfection-wise. Most people, let's be honest, would not take a trade in front of the FOMC meeting. The safest trade to Wyckoff is a breaking of the ice and a retest of the ice. Okay? This would allow you to take a position here. If you can get one, you can get it. The point is the schematics of everything. If you miss it, you miss it. But at least you're not long. Okay? But this action of selling was a CM telling you, folks, we ain't going up. Bad English, I know. But we ain't going there. And we'll labor rally up. If this was a shakeout, this would have made new highs and carried on mere way. That would have been a shakeout. Quick, the thing in Japan, the tsunami, right? The markets broke hard in beans. They made new highs. There's a lecture I do with I think I did that with Gavin down in Florida about 2001 with the trade center and how that actually the market was trending down and then the market made a bottom there. Okay, and then bad news. Markets do not top on bearish news. Markets do not top on bearish news. They top on bullish news. So this situation with Ukraine was taken with a grain of salt because the markets never reacted. And we'll go there a little bit in the S&P. It was taken with a grain of salt. Okay, and because that was the case that the market didn't react to it, the news didn't matter. If people perceive the Ukrainian news as negative, it happened from the highs of the market. It doesn't happen that way. That's not how markets function. Okay, market does this, and we're currently right here. Okay, now you're starting to see some short covering in the market. Remember I told you those high-end closes here. Friday weekend, people don't want to take the risk going home in this yet. Okay. Any questions? So we did the 240 euro. This is classical. This is the story that CM was telling you. We're not going up. This was the FOMC. They positioned themselves selling and getting short, and they caught the load. Okay. Any questions? Do you trade ES in your trading room? I do. It's not a teaching room during the day per se. We have a lot of farmers and stuff that come in there because I deal with clients first, but I do make comments on the email all the time. That's my background, the S&P pit, so I trade that. Okay. Let me show you something about the Ukrainian. You're welcome. Let me tell you about the Ukrainian news. Okay, and let me show you that real quickly on that we did here. Here was the news with Ukraine, and we closed here. And if you look at the market, we closed on the high that Friday. Okay, short of an upthrust position, but tough to go home long, but short of an upthrust position. If you remember the last 30 minutes of this bar, we broke on the close. Okay, go back. We won't do it now, but go back on that day. So it's in an upthrust position. Okay, it's an upthrust position. So this is stopping action, increasing volume, lack of upside relative to the last bar. So this is more volume here on the rally than here. The range is wider here than here with larger volume. This is somewhat stopping action. They knew before on that Friday that the market is stopping action. They're getting out. F reverse result, and boom. Okay. Those of you that don't use point and figure chart, we use reverse trend lines in Wyckoff, and they use them as overbought, oversold lines. Okay. We don't draw a trend line without the parallel channel. Okay. So this is a proper line, and it made a spring here, but that's not our scope today. So if this was bearish on the news on Monday morning, remember Sunday night we gapped lower, if you remember? If this was bearish, this market should have fallen apart, shouldn't it have? Okay? Should have been falling apart. Well, we did open up lower, but look what happened. We retest. It's just a retest of a buying bar. And the close, there. Now, I don't know if you know this, but we treat this in Wyckoff terms as if it traded, even though it gapped. Average true range, ATR, is if it traded. So the real range of the day, is like this. So it's basically almost a mid-range close and increasing volume, stopping volume. Held support, the CM held the support of the market on bearish news, mid-range close, high volume, stopping action, caused a rally. What's your prediction for the euro on Monday? That the euro will trade. Monday, the euro will open up at around 5 o'clock Chicago time and will trade. I'll give you that in a minute, okay? I don't know what's going to do, but I'll give you my idea-wise, okay? What would you draw on the trading range of your chart to get up? I did that in the newsletter last night. The trading range is obviously on the daily chart, okay? Obviously, on the daily chart, the obviously is here, and we talked about that in thing and here. That's my trading range, 1875 and 1832. You like it? Okay. Yeah, I'll do it. So that's my range. I drew that last night. This market's not relevant, by the way. This line anymore, it's not relevant because when you go up and down through it, it doesn't make a difference. So this is a vertical bar, a vertical supply bar. We mark it, okay? We don't mark these per se as being important as this one. The wider volume bars, the larger volume bars, the larger volume, it gets marked. Because once you get above this, then you'll start to make a higher high, and you can make new highs. These are not relevant resistance areas, okay, compared to this. You're building cost to go higher. If you start to take out this, I think you'll make new highs. I don't think this become relevant, okay? This is important, okay? So we are higher. So the thing in Russia is getting worse in a sense, what they tell you. And look at the market. The market is basically higher, or at least unchanged from what it was. They don't care. I give you all the bullish news in the world, all the bearish news in the world. They don't care. Okay? if you see the market breaking like this and then you get news, they care. Okay? They don't care. Not going to use military force there. Sanctions. They're having a good time at your taxpayers' expenses. Okay? You asked about the euro currency. Okay? And the euro currency I write about every day. The euro currency is what? This is a daily chart. Just show about Monday. Why did you ask about that? I'll do that real briefly because you asked the question. So we have a market here. You have to watch over for roll volume too. So right now, this is a vertical demand bar in the market. This is important support at the 138.11 area. Okay? And this is the resistance area right here because of I hate drawing bad lines. So this is where you're at market-wise. 138, 139.32, 137.11. The volume is drying up here, middle of the range, no edge. If you'd ask me what I think the market would do, I think we retest 137.11 sometime Monday. Both news events, I'd be flat. There's no edge to me, right? Fishing in the middle. Okay. All right. Pound. Another one for Gavin. Actually is important. Okay. The British pound. Been one of the strongest markets. Trend. First important thing we look at is TREND, trend. What do we see here? What do you notice about this market? The market's in an uptrend. What do you see? A market will continue to go up until you see a sign of weakness. A market will continue to go up until you see a sign of weakness. So I'm not stuttering. A market will continue to go up until you see a sign of weakness. Okay? So we obviously have markup here, markup phase above it, and then we have this bar here. Would you expect this bar here? I wouldn't. I wouldn't. I would not expect that bar there, would I? Market's going up, but the problem is that the market is too vertical, and the cause is probably used up here. But we got some stopping action. That's not supply. It's the first break in the market. It is not supply because the volume is not high enough, is it? Then we form, this is stopping action. So we draw our line right here. Okay? We see this is the reaction low of the break. We draw our line right here. Okay? I know it's probably maybe above some people if I'm drawing my lines, but I draw lines differently than you would many times because I trade from a Wyckoff standpoint. You may have gotten it from a technical book, okay? So the market's in the middle, right? So what do you see here? Well, you see the market break, but look at the rally. Look at the story of the rally. Stopping action tells you the market is a little bit in trouble. But look what happens. The market rally, this is what Gavin talks about beautifully, that the smart money sells on rallies. And that's very, very true. Sells on rallies, springs. Okay, the sausage is being made, okay? If you notice, the selling bars overall are more sharper. It's terrible. It doesn't even make any sense, does it? Are more sharp than the rallies, okay? Market tries to go up, sells off. Market tries to go up, sells off. Market goes up, sells off. Market. This is that story bar that I refer to. This is that story bar that I refer to, okay? Right here. You see what happens right here? The market has pretty steady volume and close. So the close near the ICE support, okay, should rally. Well, look at the rally right here. The rally from here took you up to the upper end of the range. The spring rally here took you up and could not even take out this bar here. Okay? And it induced selling at higher levels. They killed demand. They killed demand. And not only they killed demand, they were sellers. How do I know that? Look at the volume. Now that volume is misleading, and I'd be lying to you if I said, wow, that's very high volume. So I don't lie to you. I don't lie to anybody. But part of that volume is roll volume from the March contract into the June contract. But not all of it is roll volume. So we still say by the behavior that the market is action is weak. So what they're doing in this range after the stopping action is killing demand. Every time the market rallies, the CM has distribution, not a Wyckoff term, Bob Evans term, has distribution, and the market is working lower. What's distribution? If you buy 5 things and you sell 7, on balance, you're short 2. On balance means a net effect. Okay? Selling of the rallies, selling of the rallies, selling of the rally, selling of the rally, selling of the rally. Now the subsequent rally is weaker, and the market now, this is a current chart. I told you I can use current charts. The market goes down and breaks the ice. So tell me the quality of the supply. Is it high or is it low? Good news for you British fans. This is a shortening of the downward thrust. The shortening of the downward thrust. The market's making lower lows, barely. Coming into a demand area. I'd like for the market to hold here the 164.20 area and have some type of make new highs. Unless we see supply. We do not see supply in the market. We see stopping action. We do not see supply. This is not supply. Okay? Had the market closed like this, down here with this volume, would have been the sign of weakness. This is not a sign of weakness. It's stopping action. There's no supply in the market. The trend is up, and you are looking to buy the market on a spring. There are 2 buy setups, a shorting of the downward thrust and a spring to buy uptrends. Okay, that is your pound. Okay. Any questions? Any questions? I hope if you don't understand, I hope that I hope you do. You don't. There's Gloucesters and Wyckoff. There's everything. I'm sure Gavin can help you out very well with that. Okay. You love the explanation? Good. I hope so. So stopping action is not a sign of weakness. It is just a normal reaction to bull market. Correct. Stopping action is markets. If you're driving a car and you're driving a car from California to New York and you fill your tank up with gas, you have to refuel, get something to eat and everything else, right? So it's that you're still in the same direction, even though you're stopping to get fuel and stopping, you're still on your way. Springs in uptrends, a stopping action to go to new highs. So up thrusts in down markets are a stopping action to make new lows. Springs and uptrends you buy. Up thrusts in bearish markets you sell. They're stopping action. Springs and uptrends are bought to make new highs. There's a retesting. I'll share a story. If Warren Buffett buys shares of Coca-Cola at $50 a share, and it goes and he finds value at $50 a share, that's what they do. They find value. Okay? Market goes to $60 a share, and all of a sudden you get a newsletter that you get or whatever. Warren Buffett buying Coca-Cola at $50 a share. And you go, oh man, I wish I knew when he did it. Market goes back to $52, $50 a share. What do? I would think that you'd buy Coca-Cola with Warren Buffett at 50. That's what I would do, right? If Warren Buffett finds value at $50 a share, and the market goes to $48 a share, what does he do? Does he sell or does he buy more? If he finds value, he buys more because it has value. That's why springs and uptrends are very, 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 very effective, because he's buying value. He doesn't care about the $2. He can afford the $2, okay, a share. But people say, oh, it's a breakout to the downside, I'll sell it. No, he's buying value, okay? So stopping action because of the lack of follow through on the next bar. To a degree, James, yes, but not always. It depends upon where the Wyckoff wave structure you are. It depends on the trend. You could have stopping action in a downtrend and have lack of follow through to the downside, but you do not need supply. This is where people don't understand volume. You do not need, this is very important, you do not need supply in a downtrending market. You do not need to, well, sorry, you do not, let me take it back. Let me clarify this better for you, for the tape. You do not need a sign of weakness in a down market. Selling is enough to make you go lower. You do not need a sign of strength in an up market. Demand is enough, okay? But from an up market to uptrend to turn to a downtrend, you must have a sign of weakness. For a downtrend to be an uptrend, you need to eventually have a sign of strength in that market. That's what silver's lacking now. Silver has support, but it does not have a sign of strength yet. Okay? So because you see a market, quote unquote, bottoming, okay, and people say, oh, it's a bottom, they get long only to get wiped out, to Wyckoff, you must have a sign of strength to turn the trend from down to up, which happens on the right-hand side of the market. You need a sign of weakness in an uptrend to turn the trend from down to up. Otherwise, no go. Now, can it counter trend for a while? Absolutely. But the main trend will not change, which is why people in the stock market, oh, that's the top. Oh, it's the top. 5 years of market going up, it doesn't turn in 15 minutes. The Titanic doesn't turn, a boat doesn't turn in a matter of 5 minutes. Okay? Doesn't work that way. There's an accumulation, there's a process that markets go through. Okay? I hope it's a long discussion of Wyckoff and things, but obviously time is there, okay? So I got you for 7 more minutes, and then I can answer any questions you may have, okay? So the next chart I want to do, we did the S&P, we did the pound, we did the euro. Now let's do soybeans. So we give everybody currency, S&P, so we have everything for everybody, okay? I hope everybody enjoyed it. Again, I thank Gavin for his time for here. So let's look at soybeans. I did this yesterday in my newsletter in the chat room. So we talked about vertical bars being very, very important. Okay? So let's talk about that. Okay? People talk about head and shoulders. They took that actually from Wyckoff term afterwards, and I'll explain to you what it is. Tell you an interesting story in a minute after I do this part. Well, let me tell you now before I start. In the early 90s, I don't know if Gavin knows the story. In the early 90s, I read about commodity magazine about Tom Williams. He was doing a software with volume and price, and I understood that he studied Wyckoff. So I inquired to him at the time. I wasn't making a lot of money at the time. Inquired about it, and he sent me this software about this price and volume. And I try to do Wyckoff in the 80s to try to get price and volume doing it. I couldn't do it. There wasn't a programmer. So Tom, I think, was the first one really to do it via the computer-wise. And I go, man, that's really cool. Clicked at it and thought it was, and I actually, to be honest with you, I didn't want to lay out the money to do it. So I went by and he wrote me back. I wrote him back, and he probably doesn't remember. I remember it. And so I'm one of the thousands. And I let it go for a very long time, and I hear his name pop up here and there. So always, really one of the really pioneers of doing that. And it was price and volume and stuff like that. And so, but it was really the start of what it was, and really, kept my interest in Wyckoff as well too, because it really was a nice explanation. Sent out some printout with the tape and everything, gives him like a demo tape with it. Okay, but a lot of stuff you see from Wyckoff happens to be from everything you see. A lot of things you see today is because of Wyckoff's work. So I know people look at patterns, head and shoulder patterns, and that was the case. So here, story of soybeans. Okay. So I thank Mr. Williams for helping me knowing that I was right. So here you see market's in an uptrend, right? No cause, and the market breaks on very high volume. This is the story. What did the market tell you right here? The up move is coming to an end, or at least major stopping action. Sign of weakness, we can look at copper. Okay, I'll ask Gavin if you got extra time. I'll do it, ask any questions. Let me ask him at the time after I do this chart. Stopping action. We care, don't be long copper for a few more days. But okay, it can get a reflex rally, but okay, it's not the proper trade. So you get a situation where the market breaks here, and the market breaks on high volume. This is stopping action. Would you expect this bar to happen here? Absolutely not. But this is a reference bar now, right? This is where this composite operator sold it. They're getting out of longs. Nice move, get out. Market, we worry about the retest, right? How long it takes. Remember the Wyckoffs work? Right, the wave. 1, 2, 3, 4, 5, 6 bars to take this out. So the break is higher than the rally. Okay. It could be a shakeout making new highs. What do you notice about the volume on the retest? Let me erase my chicken scratch. What do you worry about the volume on the retest? Compare the volume. The volume, though higher than it's been, right, is about 1/2. Very good, Eileen. You must, excellent. Half. Well, if I told you that funds and specs buy new highs, because that's what they do, did they do that? To a degree. The CM sees that. He says, nobody's coming to the party. No one's buying it up. The CM, if he sells here, he's going to defend this, right? If he's selling this, of course he'll sell it. So the CM would probably sell what we call maybe the buying climax up here. He would sell some here, and then he'd sell the rest of them on balance up here. There's a sequence how they operate, right? He saw that the volume did not, bees to honey, did not come. He knew that. So he sells the market up here, market's here, and what happens? The market breaks. Now the market volume is not high, but I told you that the market has some weakness in the background. The volume does not be high as supply. It doesn't. So is this the sign of weakness in the market? The answer is no, it's not, because it happens to the left-hand side and just beginning to go to the right-hand side. So we have the market breaks, and the market has stopping action right here. I'll go a little bit faster. Stopping action right here. It stops at support, reaction high, and makes our famous spring and goes up. Okay? We judge the quality. Marco's here. This is a retest. I draw my line here because I draw from a selling bar. This is not a proper line to draw because it's not a resistance bar. The market stopped there because of time. It is not a resistance bar. How can you call it a resistance bar? We close on the highs. It's not. The resistance bar is this. Okay? Now, our favorite trade is to sell an up thrust when you have weakness in the background. Weakness in the background, the highest volume. That's what I mentioned yesterday to people. It was at 1446, I told them. Boom. How do you pick your support bar? I pick it by demand. I pick my resistance bar by supply. That's why I pick my support. It's a whole lecture with the one-on-ones I do, a couple lectures actually. Drawing trend lines are extremely important. Okay? Weakness, CM telling you a story. Weakness, CM telling you a story. Composite operator, smart money. Okay? Get out. You do not sell the first break in up market. You sell the retest. Here, you sell the retest. Okay? Now, the market is forming what? A trading range. Isn't that? Trading range. Okay? We are now forming what we call the right-hand side, where we get our sign of weakness. The market will need a sign of weakness for markdown. What does a sign of weakness look like, folks? Looks like a bar like this with high volume. You get that, party's over. Party's over. You get this on a light volume retest, you want to buy the spring to go higher. How do I know it's going to happen? I have no idea. I have no clue. Okay? But what I do know what to look for. I do know to look for a sign of weakness here. If I don't get it, we're going to hold the spring low. Then it becomes a weather market. Story, one bar, this. Story, slower retest than the break. Story tells you distribution process. Break makes a new low, goes higher. Okay? There's a difference between a swing low and a low of a market. Okay? Big discussion on that, but we obviously don't have time. But it's a vast subject, Wyckoff. Story minus CM says the party's over. Retesting, no demand. Market then what? Market then distribution. Story, market then has an up thrust. Stop is above here. Okay? Middle range, no edge. Look for a retest down to here. If it's fast with high volume, sign of weakness. If it's slow on light volume, spring. Okay? Most of this will be archived in the VSA club. It should be. I'm sure. I'm sure that it is. I don't know what Gavin does with his. I'm sure it is. Gavin, is it all archived in your VSA club?
Yeah, it is. Yeah, this will be in the tradingthemarkets.com website as well. And what we'll do, Gary, very good presentation, by the way. We'll invite you back next month and do a follow-up, and maybe we can do some live trading together as well. Invite you into our live trading room, and you can watch me trade. And,
Absolutely.
I know you'll. Yeah, we'll do, and we'll identify these principles in real time, because they are there. Interesting. You talked about the British pound there. We have a trade alert service that we operate where we did a short on the pound. Actually at the beginning of the week, and it's worked beautifully. And it's based on everything that you've talked about. So superb. Hello, Eileen. Nice to see you. Yeah, it was great. Now, let me see. Is there any questions for Gary? Or if you want to contact Gary, his details were up there earlier. We will email you Gary's details. He's a broker based out of Chicago. But as I said, I've worked with Gary in the past. He's a great guy, as you can see, very knowledgeable about Wyckoff indeed. Got a lot of knowledge. So if you're interested in Wyckoff, excellent presentation. Okay, great. And Park's just saying great presentation. So Gary from Grigory and I here in Moscow, downstairs in the lobby. Well done. Great presentation.
Hey, Gavin, can you give me like 2 minutes? Somebody asked about copper. Because I want to go copper.
Sure. Well, I'll tell you what. Gary, what I'm going to do, I'm going to switch off the recording because I've actually only got a few minutes left on my battery. So
okay.
I'll leave you in the room for a few minutes. I'll still be in, but I may not be able to talk, just so you know. So I'm going to say can you all please do say thanks to Gary Fuller, who's given up his time today to contribute to this week of Wyckoff. And we do appreciate it, and I'm sure we'll be doing some live trading with Gary in the next few weeks. Should be good fun.
Stay there 1 second. I'm going to do copper. I apologize. Yeah, it's an honor to be with Gavin and stuff like that. Gavin probably has to leave because I think it's like about 4 or 5 o'clock in Moscow, and the vodka's probably 7. The vodka's probably going to be flowing on a Friday night. So instead of having tea and a hot toddy, but in Rome, what the Romans do.
I wish you were right, Gary. I'm actually up early. I'm up early tomorrow. I'm presenting as one of the main speakers here, so I'm going to be in bed I'm going to bed about 8 o'clock. So I wish that was the case, but it would be nice.
Good luck with that.
It's a lot of people here. There's over 1,000 people here, so it's a big event. Big all forex traders, and very few of them know anything about volume, which is going to be interesting.
Oh, fantastic!
So,
all right, I wish you all the best. Be well. Thank you so much.
I'll call you when I get back, Gary.
Take
care, mate.
Be well. Safe travels.
Cheers.
Cheers. So let me do copper for you, for example. I want to thank Gavin Wise. Okay. Someone mentioned copper, so I don't want to not do that. Okay. So if you want Wyckoff information, you can just go to the site, email me and stuff like that. But let me do copper copper's weak. Okay. The copper had some stopping action yesterday. Okay. In the subject, we had a breaking of the ice in copper, and we had a breaking of the ice in copper. Obviously, it's clearly here. And we had weakness. We had a sign of weakness right here in copper, right? It happened on the right-hand side in copper. High volume type of thing. Now, I'm not going to go through the whole explanation of copper because I only have a few minutes. But this is stopping action. You see the high volume, high end close? The market came down here. So you could probably get a retest back up to here ultimately, but you need more calls here. So this is a light volume rally. It's a lack of demand. Okay? So copper is oversold from the standpoint of too far, too fast, but it was stopping action here, and I would look for a sell in copper. The trend is down. Okay? The trend is down. Okay? So I'd be very careful with that. Okay? I would be very careful with as far as that goes. Okay? Someone asked me about the website address, and you're more than welcome to go to the website, look around there. It's a new website. If you want my email directly to me, okay, it just goes directly to me versus like my company-wise, riskybiz90.aol.com. But LTG, we've got a ton of platforms, got a ton of stuff, competitive rates and stuff like that, and everything else. But not, teaching-wise, newsletters, one-on-ones, and stuff like that. A lot of free stuff too. Okay, so we'll see. So what was a stopping action that didn't result in a reversal yet? There's no cause. You have no cause down here to build it. Effort versus result. I mean, a cause versus effect. There's no cause to sustain a rally. Can you get up to here? Of course you can, right? Can you get up in here? Of course you can. But the trend is down. You're looking for an up thrust or stopping action to get short. Worst case scenario, you get a sharp rally and a secondary test to buy it. But this is too early in the process to consider long if it's a trend. Can you scalp it on a short-term basis? The answer is yes, you can. Okay? Is it right to be long as a position? The answer is absolutely not. The trend is down. So we need accumulation for the cause, absolutely. And you need a sign of strength. Too early in the process. You're off 50 points, I take it like a thief. Could you go higher next week? I would, but I wouldn't. But you're going against trend. You're taking a shot doing that. Would not do it as a position. You want to do it as a scalp? Not a problem. Do it as a position, it's not the right position. We need those buyers to show up after accumulation. I understand. Yes, you do. It's a whole course I do on this stuff with Wyckoff course and everything else. But feel free to look around the site. I'm in there now. I go to the chat room afterwards. I do a couple more webinars today. But be free to come to the site. It's mostly not as serious Wyckoff as I'd like it to be, but I'm dealing with clients and things of that nature. But you're more than welcome to look around, kick the tires, ask Gavin and VSA and everything else, okay? CQG Trader or X, I am very, very, very partial to CQG because they take out bad data and they use them on the floor and they condition us, and they used to be the first ones to get the results and everything else. I am very partial to CQG. I don't know anything else, okay? I offer all these platforms with the various firms, and I'm an independent introducing broker, so I can clear anybody. But so if somebody was one firm, I could broker your stuff as well too. But and we do Forex is the firm I do too, but I don't do it personally. But the thing is that QTrader is if you need it's really cheap now. I used to pay $800 a month. I probably spent a couple $1,000,000 in quotes for them over the years, right? Since 1980s, whatever they paid. But if you need help with QTrader, let me know. It's fantastic. I know like the back of my hand. When they have people on, I tell them, yeah, I just do everything. Yeah, absolutely. Yep. Yeah, I clear them too. Yeah, that's right. That's right. It's $40 a month. You cannot get. It used to be $700 a month. They don't have. Yeah, I have both of them. Absolutely. The integrated client's about $800 a month. Exactly. So yeah, why? What'd you do? Yeah, it's $800 a month for the large chart. So I use this one now because, long-term charts I get once a month. I have them. Yeah, great. They're a good firm, Michael. They I use them as well too. I clear them as well too. Okay, so any questions, anything, let me know. Okay, and absolutely, I do it. I work. I used to work downtown. I work out of my house now because I have a lot of clients that are not California or Europe. And instead of thinking how would you have driving over Chicago, I work on my house so I can I can service them. So that 3 hours of traveling here and there, I love what I do. I've been doing it since 1981. So. Been doing it for 19 and 13, 19 and 14, 33 years. Yeah, long time. So anybody, price and volume I think is important, and a lot of risk. Okay? So you believe the forming a trading range before a sign of strength to end your uptrend or a sign of strength will end the downtrend. So you need to build cause for your next move. Yes, you need to build cause. So that's what silver is doing. It's building cause. Okay, so in silver, for example, okay, the market is building cause. It needs a sign of strength or a sign of weakness in silver. Okay, so that's what I'm talking about. You're at support in silver, but you need a sign of strength which you don't have. Okay, you don't have that. If you get a sign of strength here, then you go up. Okay, you need a sign of strength in order to go up. Okay, I'll go to my chat room, the LTG chat room. You can go there now if you like. It's kind of a slow day, not much is happening. I'm going to be there. I'm doing a webinar now at 10:30, but I'll be there. And any questions, feel free to write. Feel free to write myself. Feel free to write Gavin. And hopefully we do more of these. And I think today was a very good session. And I'm usually critical myself, but I hope everything worked out well. Any questions, feel free to ask. That's how we learn. No dumb questions, okay? I wish everybody a good, safe, warm weekend. Yeah, riskybiz99@AOL.com. Correct. That's directed to me. Where are you located, Michael? Are you in the States? Your email, yeah. You really enjoy it? Yeah, I'm more than welcome to answer all this. This is directed to me. You can write GFull at LTG, but this gets me quicker. I mean, well, that's the same thing, but It's just a lot easier because I check my email like every minute, okay? Oh, you're in Sweden. Okay, so I have people in Finland, not Sweden. Good. So AOL, oh, sorry, that's not right, that's not right, that's not right. Don't write that down. That's directed to me. Okay. Tell me, and let me know just for your trade guide so I can let Gavin know. There's nothing here. You have a school here. Yeah, I know, but Sweden's a great thing. So great webinar. Hey, Park, nice to see you again. Tony, nice to see you. Miss Lily, thank you. Eileen, thank you for the great questions. Appreciate it. Your knowledge seems to be good. So thank you so much. God bless everybody. Have a good, safe weekend. Be well. Take care of yourself. And hopefully we'll see you in the future, okay? And those expressions, see in the future, not in the pasture, right? So be well, everybody. Stay safe, and we'll hopefully talk to you soon. Feel free to look around the website, and feel free to talk to Gavin, okay? Thank you so much, and don't be strangers, okay? Thank you so much. Good night, everybody, or good day, everybody. Bye-bye. Cheers. Be well. Thank you.